Joint ventures are really a trending topic on Property Tribes and in the wider property community, and I'm delighted to be joined now by mortgage broker Lisa Orme, and we're going to talk to Lisa about JVs from a lender perspective, because you and I have had a few chats about this, haven't we?
Yeah.
And you're very keen to bring clarity to some of the issues. Now, let's start off with a JV partner supplying the deposit for a property purchase. Now, there could be issues with that, couldn't there?
Yeah, well, whoever's putting in the deposit needs to be on the loan because it needs to be declared to the lender. All lenders ask where the deposit has come from. Doesn't matter whether it's buy-to-let, residential or commercial. They all want to know where the deposit has come from. And the aim with that is that the borrower, they want to have some skin in the game. So if it's not come from the borrower, they want to understand why that is. Now, if it's a family gift, most lenders will accept that. But gifts from strangers or joint venture partners don't happen. Nobody gifts you money that isn't expecting something in return. So now you've got a situation where you're 100% geared effectively as far as the lender is concerned, and no lender's going to lend on that basis. So the normal requirement is that whoever's putting in the money goes on the loan. Now that can be two parties on the loan and only one person putting in the money, but putting the money into your bank account 3 months in advance, which some people advise, or putting it into the limited company and then pretending it's yours, is just not acceptable to a lender. It's as simple as that. The issue that you've got is if you then go on the loan together, whether you're directors and shareholders of the company or whether you simply go on as two people on a loan, is that you're now linking your finances together, and that in itself can be dangerous. I've had clients contact me who have gone into these arrangements with other brokers because we don't normally recommend it, and have then ended up being stitched up by their business partner, or their business partner's declared bankruptcy. I've had that without even telling them, or have got into trouble, and your finances are linked, no different from if you went onto a mortgage with Mr. and Mrs. Then your finances are now linked. They're linked for at least 7 years beyond the end of the loan, because that's before it'll drop off a credit file. So if your partner that you've gone onto that loan with misses credit card payments, misses mortgage payments, declares bankruptcy, gets a CCJ, you are going to be affected. There is no getting around that. So you have to be 100% sure of the person that you're going into that relationship with. We normally insist that either it's a familial relationship, that you're already family, or that you've already been in some sort of financial or business relationship together already, so that you've already got that connection. What worries me are the people that are going on events or going to training and just going straight into these JV partners with people that they've never met before, and they have no clue about the risks that these joint ventures are causing.
No, you call those stranger JVs, don't you?
Stranger JVs, we call them, because that's essentially what they are, and even then we get people who come to us, it's okay because I've played squash with the guy for the last 3 years. Well, sorry, that doesn't really, warrant going into a financial relationship with somebody. You do have to understand, and one of the things I often say to people is get copies of each other's bank accounts and bank statements for the last 6 months, swap credit files, and are you prepared to do that every 3 months? And people are generally horrified by that. And I think, well, why on earth were you going to go into a financial relationship with this individual if you're not prepared to share that information? It's the same information that you would, most people normally share with your husband, wife or partner.
Indeed. And I was going to say that if we could just be very specific on one point, if the JV loan for the deposit was not declared to the lender and was not transparent in that regard, you would consider that to be a fraudulent mortgage application, wouldn't you?
Absolutely, yeah, because it will always say what's the source of the deposit on every single application that you put in. And if you declared it was from a JV partner who was not on the loan, then the lender is 99.9% of the time going to decline that. So the only other way that you can have done that is by telling them that it wasn't a JV partner's funds, and generally people are advised, clearly not by me, but to say that the money's been in the account for 3 to 6 months and then the lender won't know, or to create some sort of, I loaned it to a company and then took it out of the company and then I paid it back. Any of these subversive techniques are effectively mortgage fraud, because it is not your funds, and that's what the lender wants to know. And the lenders are cottoning onto this. They're not daft. They see this. They're on the forums, they're on the Facebook groups, just like the rest of us are. They see how people are structuring these deals. They even go on the courses, and they can see how people are structuring these deals. So that just makes them ask all of the more questions, make it all the more difficult for the genuine borrowers, ask for more paperwork. And then if you do get caught out, then you're going to get declined, and it may even end up with a fraud alert and inform of the lenders as well.
Just to finish, Lisa, I think when JVs go wrong, they can go spectacularly wrong. And we've seen the recent case of the Susanna Cole JVs that have fallen out of bed, and there's been a massive social media storm about that. And, I think obviously we hear about the ones that go wrong a lot. I'm sure, of course, there's lots that go right as well, but probably the ones that go right are the ones that are actually set up properly. And I know that Nicole Bremner pays about £3,500 per legal document to get the documentation absolutely bulletproof. And I think that's surely the way forwards if you want to protect yourself.
Yeah, what I tend to say is that use investors in a cash basis, so buy properties cash instead. You could give them a first charge, that type of thing. You're not connecting your finances with loans and things then. Another way is to use them in the short term. Bridging lenders can be a lot more flexible with third party funds, again as long as it's transparent, but they can be a lot more flexible. So you could bridge and then refinance out your business partner. I think the worry for me is the ones that are going into long-term arrangements, and those are the dangers. But I've seen it where people have gone bankrupt, or somebody's died. That's another incident. Or somebody wants to come out of a partnership. I know somebody where they fell out, wanted to come out of the partnership, and was almost forcing the other party into bankruptcy because they were saying, "I want my money back," and we've fallen out, and I'm no longer interested. I want my money back. So these are the things that happen. Everybody's always happy when they're going into the deal. It's when they're coming out. You might find yourself, if your business partner dies, suddenly in a financial relationship with their wife, 3 kids, and the RSPCA who they donated the money to. So all of these sort of things can happen. You do have to get very strong, very robust legal agreements drawn up. But my advice would be to do them on short-term basis, not go into these long-term finance arrangements with complicated structures and deeds of trust and all of these sort of things. That's where it's going to come back, and it's going to hurt when it goes wrong.
Well, absolutely awesome advice from Lisa, as always, and I do hope you've enjoyed this in these insights that Lisa's given. And Lisa, some people say you and I, we're neg heads, we have a can't do attitude, and I think we both want to say that we're not dictating to anybody how they should run their business. We just want to make people aware of the reality of these issues, and you've given some real life examples of when things have gone horribly wrong, and if you're aware of the pitfalls, you can avoid them.
Absolutely, it's not about being negative at all. It is about avoiding things when they go wrong, because that's when everything falls out of bed. Is when things do go wrong. But also, as a mortgage advisor and a property investor myself, is that I do see both sides, and that the more people try and get round these things. I'm all for creativity. That's what I'm known for. Ask any of my clients that. My clients are all quite happily making money doing it legitimately. Otherwise, I'd be broke. So it's not a case of you can't be creative, but you can do it creative and legitimate, and that's the big difference. So you can make money, just do it the right way. That's my big motto. It's not about being negative. It's just we all want to make money, we all want to be creative, but there's ways to do it, and there's definitely ways not to do it. It's not about being negative at all.
Hear, hear. Well said, Lisa, as always.
Thank you.